So where does the banking crisis put us in terms of the Fed achieving that soft landing?
There is an unintended consequence of all of this. So now banks are going to have to be more defensive. They're going to have to really slow down in originating new loans, and they're going to be very careful with the cash that they have on hand. So, over the last 10 years, banks became stuffed with cash. There was stimulus from 2008, there was stimulus from COVID. So there was a lot of ample opportunity to lend money out and try to make money off of the arbitrage situation from the difference of lending rates and savings rates. Today, that is not the case. So I don't think Fed Chair Powell intended for these banks to fail. I don't think anyone thinks that. But at this point in time, banks are going to have to be very careful. And that's exactly what the Fed was hoping would happen, to slow down the economy, to tighten the money supply, to tighten credit conditions, to make it tougher to stimulate spending and borrowing. And because of that, that could actually be an overall positive for the market. Even though it hints of a recession, that's the kind of language that the Fed is looking for. Hints of a recession without a full-blown depression or crisis. And unfortunately, a few banks, had to take the axe, but it looks like it could be an overall positive for markets as the Fed's agenda is carried out.
Do you think the Fed will be able to pull off the mythical soft landing?
The mythical, right? The proverbial at this point. I know. The other one is inflation fixation. Here we are, well into 2023, still talking about these same things with the soft landing. So the data points to a soft landing currently. To put it bluntly, a mild recession at worst, and not to say that inflation data and other data can't change. But currently, if you look at where GDP came out for the first quarter, 1.1%. Not exactly a blockbuster number. But if you take it inflation adjusted, that number was 5.1%, which actually is a pretty great number. And you have to remember, corporate earnings aren't inflation adjusted. So that shows some real strength when it comes to how fast the corporate earnings in this economy are growing right now. So that's probably first and foremost. GDP, not as bad as it looked from the headlines point of view. Second, unemployment has been amazingly strong. The unemployment rate just won't go up. If you look at jobless claims, 1.8 million was the most recent figure, and that's up from last September, which was really the low of the low in decades and decades, since I think the 70s. And that was at 1.3 million. So 1.3 versus 1.8, 30% jump. Sounds kind of drastic. But if you just go back a few years, during COVID, jobless claims reached 20 million. And during the Great Recession, it was at 6 million. So we're nowhere near any of those catastrophic type of unemployment numbers. And if unemployment remains low and the job market is strong, it's really hard to predict or even forecast for a deep recession at that point. The consumer is still strong. I mentioned a lot of cash on the balance sheets that's still there from, yes, a lot of government borrowing, but it's in stimulus. But that's led to a really healthy consumer as well. So the data points to an economy that's firing at all cylinders, but not doing it overboard or running too hot. A lot of Goldilocks type of numbers. So I think the mystical proverbial soft landing might be able to be achieved after all.
Stonebriar Wealth Management, advisors for your life.
This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process described herein will be profitable. Investors may lose all of their investments. Past performance is not indicative of current or future performance. It is not a guarantee.